What is going on, everyone? Welcome back to the series. This is lesson number 5. And before we go any further, I do want to say thank you guys so much for your incredibly positive response to these videos. I've gotten a lot of messages and comments saying how much confidence and just overall understanding of what the world of trading actually entails. And I'm so happy and honored that you guys are able to absorb that information here in one place for free, which is what this series is all about. You know, I'm doing this because I have this sick, crazy obsession with the world of trading, and I just love talking about it. And there's just a cool thing about being able to teach people the way that I would have want to be taught when I started, because all of the information that I'm pretty much giving to you guys is available at some random corner of the internet already, right? So the cool thing about what I'm doing is I'm compiling all of that knowledge, everything that I've learned into one place and keeping all the fluff out of it, because I wasted so much time at the beginning learning a lot of useless shit, you know what I mean? And that's what I wanted to do for you guys, is put everything that I have found to be valuable in one place. And you guys could basically just do whatever you want with that information. You might discover someone else that you like their style of trading more and you want to learn from them and just sort of stick with them in the future. Great. Or you might decide, hey, this trading thing isn't for me altogether. I'm just going to do something else. Cool. Great. That's the best part about this community and this series, is that you can make that decision on your own without technically spending a dollar, because I'm giving you all of this information for free, and it's just for the love of the game, really, honestly. So thank you guys again for being here. This lesson is going to be on fair value gaps. Now, if you go back to the last lesson where we talked about liquidity, I will always, and anybody should really always, consider liquidity to be the number one. It's the king of all confluences. It's what we base everything about our trading around, is the concept of liquidity. Fair value gaps aren't too far behind that, really. They sort of provide like the roadmap or the guiding light into what next levels of liquidity we might be actively seeking, right? Sort of what direction of order flow we are truly trading in at any given time. The great thing about fair value gaps is that, yes, they are very important to our trading, but they're also pretty easy to understand, the overall concept. So what is a fair value gap? A fair value gap is pretty much a 3 candlestick pattern, and when it forms, it pretty much represents price delivering so heavily and quickly in one direction, thus creating an imbalance in the market, right? Because price is traveling so quickly to where it's not offering an efficient amount of orders in the opposite direction. In a funny way, you could kind of look at it in a way of, say you're mowing the lawn, right? And you're sort of just really rushing through it. And all of a sudden you look behind you, and about 20 feet behind you, there's a massive section that you skipped over, right? So what you're going to do is go back, mow that little section that you missed, and then continue on with the rest of the yard. Well, that is kind of how the market likes to behave, because we are displacing so heavily in one direction. And typically what you will see is price trade back to that fair value gap and then either respect it or disrespect it, which we'll get into in a little bit, which allows price to either continue in the same direction or indicate a potential reversal in order flow in the opposite direction. So what does a fair value gap actually look like? Well, I drew a fancy little visual example right down here. Now, like I said at the beginning of the lesson, a fair value gap is a 3 candlestick pattern that represents an imbalance in the market from the amount of displacement in price. So visually, how is that represented? Well, right here we have candlestick number 1, candlestick number 2, candlestick number 3. Okay. And this would obviously be a bullish scenario, right? Price is ripping to the upside in this scenario. So a fair value gap is actually formed when the highest point of the wick from the first candle and the lowest point of the wick from the third candle have a gap in between them. Okay. So in this scenario, our fair value gap exists right here. This box is where our actual imbalance is in the market, okay? So the highest point of the first wick, lowest point of the third wick, the wicks on the second candle, aka the middle candle, do not matter at all. This wick could come all the way up here for all we care, does not matter. This could have no wick or another long wick on the bottom, doesn't matter. We still have a fair value gap in this scenario. Now, another thing to consider is that all three of these candles don't have to be green candles. So let's draw this out a little differently. Let's make this third candle a bearish candle. So in this scenario, we have a bullish candle on candle number 1, on candle number 2, and this is a red candle. Price is technically going down. However, as you can see, we still have a gap between the highest point of the first wick and the lowest point of the third wick, right? This is still a fair value gap. All right, so let's keep it simple and go back to our original example right here. What happens if the wick from the first candle comes all the way up here and everything else is the same? Is this a fair value gap? No, because the highest point of the first wick and the lowest point of the third wick overlap, as you can see. So there is no gap in between here in this 3 candlestick pattern. Okay, so obviously a bearish fair value gap is the same concept, just in complete opposite form. In this case, it is going to be the bottommost point of the first wick and the topmost point of the third wick, creating a gap. And here between these lines is going to be your fair value gap right here. So you can see here visually that price displaced so heavily downward that we didn't properly offer buy orders in this fair value gap right here. Okay, that is what the fair value gap represents. What does the market like to do? It likes to rebalance these inefficiencies or fair value gaps. So this is a prime example of what it looks like when the market rebalances inefficiency and then continues in the same direction. So let's go back to the first step here. What do we create with these 3 candles? A fair value gap, because the bottom point of this wick and the top point of this wick do not overlap. So these horizontal lines right here represent our fair value gap, okay? So what does price do after this candle? It comes up, rebalances, and respects this fair value gap, and then price continues to dump lower. Okay, now what exactly do I mean by respecting or disrespecting a gap? Well, this right here is an example of a gap being respected, right? Because this is a bearish gap. What we do is we fill it and then we continue lower. Now, respecting and disrespecting gaps is all about candle closure opposed to just the wicks. So what I mean by that is if we wick all the way up here and everything else is the same, this is still considered respecting that gap. Now, in this scenario, we still have our bearish fair value gap, but as you can see, this candle here closes above the gap, which is technically disrespecting the fair value gap. And as you can see, price in this example delivers higher. So this is how we could kind of mold our narrative when we are disrespecting or respecting either bearish or bullish gaps to then seek out old levels of liquidity. Now, typically what we are going to see is back to this scenario where a gap gets respected, because if we are displacing and trending so heavily in one direction, typically what the market likes to do is trade back to that inefficiency, rebalance it, and then continue on in the same direction. However, if we start disrespecting gaps, that is equally as important of a telltale sign that we could be headed in the opposite direction. So a couple notes that I'm going to jot down here for you guys. You could either screenshot them or write them down yourself. Either way, just remember these foundational points of what fair value gaps are, right? So 3 candlestick pattern where wicks of first candle and third candle do not overlap. Okay, that is the number 1 most important part. Okay, number 2, it does not matter what color all the candles are. You'll be able to tell if it is a bullish or bearish fair value gap based on the direction of the 3 candles. However, if the first 2 candles are green and the third one is red, it does not matter as long as the wicks do not overlap, okay? Number 3, the wicks on the middle candle are irrelevant. Does not matter at all. We do not care about those wicks. Okay, number 4, and this should be the last one, is respecting or disrespecting gaps is dependent on candle closure, not wicks, right? So we can wick up above a gap in this scenario all the way up here, and it does not matter as long as the candle closures stay within the gap and then continue in the same direction. That is considered respecting a gap. Also, it could be more than 1 or 2 candles. There could be 5 candles that come up and test that gap and then continue in the same direction. That's still considered respecting a gap. If we have candle closure above a gap, that is disrespect. Even if we continue in the same direction, this candle closure above this gap is disrespecting the gap. Now, this scenario right here is still useful to us, even though price comes down and still delivers lower. The fact that this gap got disrespected might show us a little bit of uncertainty in the market. Nothing in the market is random, right? When you see things happen, you have to use those as tools, as guiding lights to say, hey, are we in high probability conditions? Are we delivering heavily and confidently in one direction? Are we respecting gaps? Are we disrespecting them? Do we have clean draws on liquidity? All of these questions are constantly cycling through your mind when you are actively watching the market. So it's important to really be able to understand all of these concepts in real time. Now, let's look at an actual chart example. I want to make sure I zoom in enough so you guys can actually see these things happen. Here is a couple great examples. So, what do we have right here with these 3 candles? Let me zoom in a little more. We have a bearish fair value gap. Okay, so let's mark that out. Okay, so there is our fair value gap. Now, the next candle displaces above and closes above that gap. So what do we have right there? That is disrespect of that bearish fair value gap. What does that tell us? Price might want to seek out liquidity in the opposite direction. Okay, when I say that, this is not just always the case. Just because we disrespect a gap does not mean we are automatically headed in the opposite direction. There are no guarantees in the market, but we can use these as tools to give us better guidance. So what do we start doing on the way up here? We start creating bullish fair value gaps, right? So between this candle right here, this candle here, and this candle here, you could see we have a bullish fair value gap. Now here's a great example. This bearish candle can be a candle in 2 sets of fair value gaps, right? Because we have this bearish one right here, and then we also have this bullish one that's formed. It could be a part of both. And like I had mentioned before, these are different colored candles. It is still a fair value gap because the wicks do not overlap in candle number 1 and candle number 3. Regardless, what do we start doing? We start creating these bullish fair value gaps on the way up. So like I said at the beginning of the video, the market actively likes to rebalance inefficiencies before continuing in a direction. It doesn't mean it always has to happen, but these gaps act as a magnet and sort of like a slingshot in the same direction to continue higher, right? So what do we do here? We have candle number 1, candle number 2, candle number 3. That is our gap right there, okay? The market comes down, fills it perfectly, and continues higher. You can see the wick comes just below, but we do not care about that wick, okay? The wick can come all the way down here. As long as that body closure is within the gap, we are respecting the gap. Regardless, we continue higher. Heavy displacement to the upside. What do we have here? Another fair value gap. Okay, here is a fantastic example because what do? We form our fair value gap, we come down, partially refill it, we partially rebalance it, right? Respect it, and then what happens? We trade back down and fully rebalance this gap, right? We are still respecting it because there's no candle closure below the gap, and then we continue higher, okay? So when we look at this scenario, what can we also keep in mind to confirm that we still want to go higher, right? Because this move can scare a lot of people. We can come down, fill this gap, start continuing higher, and everyone thinks, all right, we're going to keep going, right? Like we did down here. But what the market does is it comes down, manipulates, right? Sweeps out this liquidity, right? And then continues higher. Also, if you're a beginner, you might be missing another little telltale sign. What is that? What do we have right here? A bearish fair value gap, right? And what are we doing with this candle? We are disrespecting that bearish fair value gap. In other words, known as an inverse fair value gap, okay? So what does all this tell us? What are we doing here? We're respecting bullish fair value gaps. We're disrespecting bearish fair value gaps. Where do you think price might want to go? I think we have our answer. We go higher. Okay, so now that we're starting to tie in some of these concepts together, you can see how we are actively putting this puzzle together. It doesn't have to all make sense right now, but as you can see, it's kind of cool when you're able to identify all of these things come together and actually make sense in why price delivers the way it does. There's nothing random about the market. That's the best part, is that all of this is happening on purpose. Even if we quickly go back to our lesson on liquidity, and we're talking about swing lows and swing highs, and you might ask yourself, well, isn't it weird how we didn't come down and sweep this low, right? Because this way comes down here and we still just went higher. Well, what is that considered? That is considered generating liquidity, because what do we do a couple days later? We built this low, and even this low, and what do? We come sweep it out just to continue to drive the market to specific levels where the institutions are able to fulfill their orders. But let's go back to fair value gaps. As you can see, this can happen on any time frame, and it happens like magic. What do we have here? Heavy displacement. We have multiple fair value gaps right here, and this is actually a great example of what I want to get into next. Okay, so on this leg we have a gap right here, candlestick number 1, 2, and 3. Right there is our first gap. What else do we have on this leg? We have a gap right here. Okay, another bullish fair value gap. And in this scenario, you can see that this large bearish candle right here closes all the way down here. So what does it do? It disrespects this gap. However, we still have this inefficiency down here that the market would like to rebalance before ding, 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 you got it, driving the market higher. Okay, so just because we technically disrespect one gap, you have to look at the bigger picture. We still have unmitigated gaps down here that would like to be rebalanced before, in this case, driving the market higher. You don't want to cloud your judgment and overcomplicate things by looking at every single gap. You want to always keep in mind the bigger picture. But as you can see in this lesson, as we just get into the basic concepts of fair value gaps, just look at the way when these gaps are formed, we like to come back, at least partially rebalance them to then continue in the same direction. So what I want you guys to do is similar to the previous episodes, go through on your charts. It doesn't matter what time frame, you could switch between all of them, switch between the 1 minute, the 5 minute, the 15, whatever you want, and just start identifying fair value gaps and how we either respect them or disrespect them and see the reaction thereafter. Just come through, zoom in, and you could see right here, just start going through examples. Start reading the market for what it's actually telling us. Let's go through another example right here. What do we have? A bullish fair value gap between this candle, this candle, this candle. Let's mark it out real quick. Boom. Okay, what do we do with this candle when it comes to this bullish fair value gap? We disrespect it. Okay, but what do we do in the meantime? We also form a bearish fair value gap between this candle, and this candle. What do? We keep displacing, come back up to fill the inefficiency, respect it, right? Because we are closing within the gap, trade back down, and what do we have once again? Boom. Continued manipulation, right? This is going to scare a lot of people out because they think the market's supposed to respect this gap and travel straight down, right? Wrong. What do we have though? We have continued respect of this gap, of this bearish gap. It wicks all the way up here. Now, when you're watching candles form and you see this candle displacing all the way up here, you're going to think, oh my God, it's going to disrespect that bearish gap and we're going to go higher. This is why right here, this is a perfect example why you always wait for candle closure, because what happens? Price travels all the way up here, snaps back down, and actually closes bearish all the way down here. So you could see we respected this bearish gap, and then what do? Shit the bed. I like that term. I don't know why I like that term a lot, but you could see I don't even need to scroll. We could go through another example right here. What do we have? A bearish gap, right? 1, 2, 3, wicks don't overlap. What do we do with these green candles? We disrespect that bearish gap. So now we might be thinking, hey, we're going higher, right? So we keep displacing higher. We come all the way back down. Boom, rebalance this gap, displace higher. So this is what I want you guys to do, is just go through your charts and just start looking at fair value gaps. Be able to identify them quickly, understand how price reacts off of them. And when they do disrespect gaps, what happens after? When they respect gaps, what happens after? This is what I want you guys to look at. A quick reminder, with almost anything in general, the higher time frames tend to hold a little bit more weight and be a little bit more accurate with its price action. If you're trying to identify a lot of this stuff on the 1 minute chart or something, things could look a little noisy, but if you go to the 15 minute, the 1 hour, the 4 hour, things will look a lot more fluid and you'll see a lot more gaps being either respected cleanly or disrespected cleanly, even though that actually sounds a little weird. But that's what I want you guys to do, is just go through your charts, see how we rebalance certain levels and displace higher or disrespect them, and then see what levels of liquidity we might be taking out too, right? What do we do here? We displace heavier, create all these gaps, come down, rebalance this leg, and then shoot higher to what? Take out this level of liquidity. This is how you have to start looking at the market. It's not going to come to you that quickly, but you have to get the reps in. You have to get the practice in. Even if it feels boring, trust me, it is very, very valuable that you are able to start treating the market like riding a bike, right? It's number one. Once you guys are done with all these lessons, let's say I do 20, 25 lessons, you're going to basically know 95 to 100% of the information that I know and use. The only thing that you're not going to have is the market time, the chart hours, the experience. And that, unfortunately or fortunately, is the only thing you can't cheat. You can't bypass that. You can't rush it. You truly have to treat that process as it comes to you. But a great way to get started is by practicing looking at the market even when the market's not moving. Just scroll back to any of these points and you'll see this is one giant puzzle that we are looking at. And what do we do when we can put this puzzle together? We fucking print. Okay? That's all I have for you guys today. I hope all this made sense. Of course, all of these concepts are going to have continued lessons built upon them. You know, I don't want to just give you this one 15 or 20 minute video and expect you to understand every aspect of it, right? Because all of these concepts could be sort of layered, but this is the foundation of it. Go through, spend the time, rewatch this video if you need to, and just get used to seeing it for yourself in the market. I love and appreciate you all. I will see you in lesson number 6, where we could start further tying these concepts together and building upon them to start getting to the point where we could actually involve ourselves in the market. So thank you guys. See you in the next one.